You're welcome to the TBX Trading Mentorship, and today we're going to continue from where we stopped in the previous course. And today we're going to be looking at what is a pip. So, pip is an acronym for point in percentage, and it is the smallest movement of a currency pair. That is, personally, I like to see pip as the SI unit of a forex or a currency pair. For instance, the way we have meters to measure length of to measure the length of a body in physics. We also have, or let's say it's in science generally, we can now call pips as the unit used to measure the movement in price or the change in price of a currency pair. So as you can see, in physics, the length of a body is measured in meters. Now, just imagine meters as pips in and length as forex. That is, it is just the SI unit to measure the change in price of a currency pair. So if you look at this currency pair, we have Euro USD is equals to 1.0650. Now you're going to wonder, there's this small five here. Don't worry, I'm going to explain that. And let me see if I can zoom in. It's okay. Oh, it's too much. Let's see if we can zoom out a little bit. Uh, I have no idea where I am. Okay, yeah, that's it. Okay, so this is Euro USD. This is a micro pip. It's actually irrelevant. This is a macro pip, sorry, and it is most likely irrelevant. So we like counting our pips. For most of the pairs, we like counting our pips from the fourth decimal place. That is the 1, 2, 3, 4. The fifth decimal place, and we have some brokers that show you the values of the fifth decimal place. I mean the macro pip, but just forget about it. We'll always start counting our pips from the fourth decimal place. So the change in price in the fourth decimal place is plus or minus 1 pip. The change in price third decimal place plus or minus 10 pips, and for here 100 pips, 1000 pips. That is, if for to say that Euro USD suddenly changed from 1.06550 to 1.0651, then we can say the price of Euro USD just increased by 1 pip. I hope you guys are getting the number. So if you say the value of Euro USD just moved from 1.0650 to 1.0660, then we can say the value of Euro USD just increased by 10 pips. So and if you say the value of Euro USD changed from 1.0650 to 1.0550, just think about it. What do you think the answer is going to be? It means that the value of Euro USD just decreased by 100 pips, and the likes and the likes. So that's how it is. So now, although, okay, as you can see, for those of you who like mathematics, it has been solved out here for you. And we have this exercise. I would like you guys to check out this exercise and make sure make sure you've solved everything and drop the answers in the group that you are currently in, the WhatsApp group you are currently in, before the next class. So and this to every law, I think to every law there's an aberration. So in the case of pips, the aberration is USJPYPS. As you can see, USDJPYPA, that is Japanese UMPS. I don't know if you've seen it already, or should I spot it out, or do you know I'm already circling around it? You can see that the PS is a little bit different from that of Euro USD, which is like 1.0650. But instead, in the case of the JPY PS, we have something like 142.48. You can see that it's different. So instead of counting from the fourth decimal place, we count from the second decimal place in the case of the JPYPS. The third decimal place is kind of irrelevant. It's also a macro pip, and it is relevant. So we start counting from the second decimal place, and that is from here. You can see that from this place, change in this price is going to be 1 pip. Change in this price is going to be 10 pips, and change in this price is going to be 100 pips. So for those of you who like math, you can see it right here, and as you can see, something like that. So and there's also a lot of exercises here that you have to submit before the next class. So chapter 5, how to calculate lot size. The value of 1 pip is determined by the amount or quantity or unit of currency pair you are trading. The quantity the amount, quantity, or unit of currency pair you're trading is called the lot size. So lot size is just a way of describing the amount of currency you are trading at a particular time. For instance, if you want to buy sand, yeah, it's a very weird example. Just go with it. Let's just go with it. If you are going to buy sand, the amount of kilograms of sand you are buying will determine the amount of money you're going to be paying for it. It's the same thing here. So the amount of lot size, that is the amount of lot size, you just have to get used to that terminology. The amount of lot size of a current of your the amount of lot size you are buying, that is the quantity of currency you are buying when you are trading, will determine the amount of profit or loss you are going to get. So, for instance, let's look at the types of lot size. We have the standard lot size, that is when you are buying 100,000 units worth of that currency pair you are buying or selling, and this is going to give you $10 per pip. So, for instance, this guy that moves pair that moved minus 200 pips. If you actually like sold this PM, you'd have gotten $10 per pip. You should know that that's going to be a lot of money like that. So we have the mini lot size, and that is 10,000 10,000 units. Sorry, not dollars. It depends on the currency pair you are trading. 10,000 units per pip, and that is $1 per pip. Micro lot size means 1,000 units of that currency pair you're buying, which is $0.1 per pip. And nano lot size is 100, which is $0.01 per pip. So now let's talk about each lot size. So you can just read about each of this stuff. I'll just try to give you a brief explanation of everything. Each lot size is just like when you're buying, like I said earlier, the amount of lot size you are buying will determine your buying power. So for instance, if you want to make more money, you use more lot size. But don't forget, the fact that you can make more money in a particular trade using more lot size also means you can lose more money in a particular trade using more lot size. And the what determines the lot size you can use in a particular trade is the same thing that determines your buying power. For like the example that we gave earlier, somebody can buy $100,000 worth of sand. Someone else can buy $10,000 worth of sand. Someone else can buy $1,000 worth of sand, and the last person can buy $100 worth of sand. What determines the amount of sand you can buy is your buying power, and your buying power is your capital. So the amount of lot size you use per trade is dependent on the capital you have or your equity in that particular trade. So you have to place your trades using respecting your capital, because if you have people that do what we call over leveraging or over trading, or you're going to get to understand all of this along very very soon. So we just want to look at how to calculate your profit and losses using all this we've learned. Now we've learned how to calculate pips, and we've learned about lot size. So if you bring all this together, we can learn how to calculate the profit, your profit or loss. At least when you place a trade, you can calculate an estimated amount of profit you might end up making, or approximate amount of profit you might end up making by the when the trade gets to your place of interest. Or if you lose the trade, you can also calculate how much money you might lose even before you've lost that particular trade. So how do we do that? We're going to follow this formula, which is value per pip. This value per pip is usually 10, just 10. I think $10. It is. I don't really know why, but it is constantly 10. I think I learned why, but you don't actually need it. Just know that it's 10 times the number of pips moved. That is, after calculating number of pips, the way we talked about how to calculate number of pips in a previous chapter, and times the lot size I we just learned. So that will be equals to profit or loss. So, for instance, if um, if you bought EU, which is a short form of saying Euro USD, with one standard lot size at 1.0504, and few hours later it moved to 1.0604, and then you decide to close the profit you've made. Then how are you going to calculate how much you've made? For instance, what is the formula? The formula says value per pip, that's 10, How many pips did you move? If you subtract 1.0504 from 1.0604, you're going to have 100. It means you moved 100 pips, and that is not 100 times the lot size. That's times one, and that is $1,000. And this is it for those of you like mathematics. And we also have something like this. Yeah, so you can just go to the book, you're going to understand more about that. And there's an exercise at the end of this, so you've got to do this exercise before the next class. So, um, chapter 6, what is leverage? Leverage is a little bit complicated. You might want to read the chapter twice, or you might want to watch this video twice, or you might just ask a question, and you might even get it instantly. Let's assume you want to buy a piece of land worth $100,000, but you have just $20,000. Then you came to me, yes, me, because I'm a really nice person, obviously, and I decided to give you the remaining $80,000 you need on these terms. You don't owe me any money as long as the land is still yours. But whenever you decide to sell the land, you must give me back my $80,000 no matter what. I don't really care if you make money or not selling the land. I just want my $80,000 back. So you have $20,000. You want to buy a land worth $100,000. Then you came to meet me. I was like, wow, that's no issue. I'll give you 80,000. I'll give you $80,000. Buy the land. I don't really care about what happens to the land. I don't care if maybe NASA cut out that land and take it to space for study. I don't care if dinosaurs come to and this. I don't really care. All I need is that anytime you want to sell the land, I need my $80,000 back. Sure you get. So now you loved my terms. We shook hands and made a deal. So I gave you $80,000 and you were able to get the $100,000 land property you desire. Few years later, the value of the land you bought, $100,000, became $150,000. So you decided to sell because of certain reasons. Don't forget our deal. I get $80,000 back whenever you sell the land. Since you sold the land at a price of $150,000, I collect my $80,000, which means you have $70,000 left. That means you and don't forget about your capital of $20,000, which means you made a profit of $50,000. That is dope. Now, if you look at this, you're going to actually like understand later. Yes, we got this from SpongeBob. Yeah, I know you noticed that, but yeah, we got it from SpongeBob. So now you made a reasonable return of over 250,000, over 250%. But not for so, but if the other way, if it happens the other way around, so that is what if few years later the value of the land end up selling you ended up selling the land at $90,000. Don't forget, don't forget our deal. I don't really care if you lose money or not. Don't forget, I gave you okay, if you end up selling the land for $80,000, then you just lost $10,000. How would I put it? The value of the land is $100,000. I gave you $80,000. Don't forget, and you bought it $100,000. So let's look at it here. You bought it $100,000. So a few years later, when you're selling it for $90,000, the value of the land depreciated and became $90,000. Don't forget, we initially bought it for $100,000. I don't really care what happens to the land. I want my $80,000 back. So this means you would have to take out of your $20,000 and add it to the $70,000 that if you remove your $20,000 from your $90,000, I'm going to have $70,000. But according to our deal, I will not collect $70,000 from you. I want my $80,000 back. So it means you have to remove $10,000 out of your 20 and add it to my 70 to complete 80 and give me back my money. You understand? So it means you just lost money. So that's how leverage works. So and you can read all of this. This is to understand leverage normally. So now how to apply leverage to forex. When signing up to a forex trader or forex broker, you definitely see something like 1:2, 1:10, 1:20, 1:50, 1:100, etc. under leverage section, blah 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 blah. So this means practically that um you are going to be able to, your buying power is going to be, for instance, when we have 1:10, it means your buying power is going to be 10 times what your capital is. Leverage in forex trading is a little bit different from leverage like I just explained, but it's kind of the same concept. Now, when you want to place trades, you understand, and you have a very small capital size, and you want to buy something like, you want to place trades of like one lot size, two lot size, you need leverage to be able to buy something reasonable from the market so you can make reasonable profits. So when you use reasonable leverages like 1:10, 1:20, 1:50, 1:100, it means that you'll be able to buy 1:10, for instance, you'll be able to buy more than 10 times what your capital size. 1:20 means you'll be able to buy more than 20 times what your capital size. 1:50, 50 times. 1:100, 100 times. But you still have to use this stuff wisely. So if you read all this, you're going to perfectly understand it. So chapter 7, terminologies used in forex. So we're going to stop here for today. So terminologies used in forex. In this chapter, we're going to look at terminologies. We have margin, and this is the amount of money you deposit into your trading account to place trade. It can also be called trading capital. Your pip, point in percent. This is it was we've learned this already. I don't need to go back to this. Lot size, term used to describe the size of your trading position. Currency pair is a pair of two different currencies. Base currency is the first currency, which is usually the strong currency, that is euro in euro USD. Quote currency is USD, the last currency, which is usually called the weak currency. When you are going long, when you go long, it means you are buying in forex, and when you go short, it means you are selling. So if I tell you that I went short on euro USD, it means I sold euro USD. Bid price, this is the selling price of your currency pair. Ask price, and this is the buying price of the currency pair. Spread, this is the difference between the bid price and the ask price. This is where most brokers make. This is where brokers make some of their money from. We also have trend, and this is the direction of price, either bullish or bearish. We have bullish trend. This is when the direction of price is upward. That is when the price is moving up, and that's something like this. And bearish is when the price is moving down, and ranging is when price is moving sideways. Something like this is bullish, this is bearish, and this is sideways. You guys get it now. We have bulls. If you are in a particular trade and you are buying, it means you are a bull. And if you are in a particular trade and you are shorting that trade, you are a bear. Margin call, this is the term used for blowing accounts. Stop loss, this is when you're trying to tell somebody professional that the person blew his account. So you cannot use margin call. Stop loss, this is an order set to close your trade if the price went against your prediction. You have to understand the fact that forex traders are not magicians, and you are, when you're predicting a particular trade, you're not like prophesying or looking for prophecies or something like that. It is not set in stone that price is going to go according to what you want it to do, or price is going to do exactly what you want it to do. It is just prediction. So you have to set limits for how much you're going to lose if price goes against you, or if price goes against your prediction. Take profit. This is another place to close your trade in profit. That is, if price went according to your prediction. We have candlesticks. This are graphical representation of price. You're going to see them very soon, and some abbreviations. You can check out all these. I personally don't use all these. I just brought them out so that you guys can see it, but I use a few of them, and that's all. Many of these terminologies might seem strange to you, but very soon they'll make perfect sense. You cannot use all of these abbreviations. I personally don't use all of them, but you're still going to use a few of them. So in the next chapter, we're going to be looking at MT4 and trading view breakdown. So in the next chapter, we're majorly going to use the trading view application on the system. MT4, I might do a screen record on my phone to show you how to use MT4 and MT5. But tomorrow or in the next video, we're gonna check it out. We're gonna be checking out how to use trading view. So that's all for today. Okay, see you guys in the next video.